Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His websites, PIFinancial.com and PolarFuturesGroup.com. Welcome back to the show, Drew.
Thanks for having me on, Jim.
Drew, U.S. markets are hitting all-time highs this week. Is this because of the good news coming out of the G20 that the U.S. and China have declared a tariff truce?
Yeah, I mean, I think that's definitely part of it. That was part of what was maybe worrying the market or keeping investors worried about being invested. And I think, with July 4th, tomorrow being a U.S. holiday, so essentially a 4-day weekend, although some people will be back in the office on Friday, with U.S. equity markets ramping up to all-time highs to close out a day in front of the long weekend, it really shows me that they aren't worried, that they don't see, risk spiking back up. We have had previously, Trump tweets or announcements on the weekend regarding the U.S.-China trade deal that investors are obviously pushing aside and, willing to be fully invested or more invested over a weekend. I mean, the G20 announcement was a positive. Trump saying that Huawei was going to be able to buy components from U.S. manufacturers, which was sort of a concession to China. However, outside of that, I don't think we really saw a lot get done other than they agreed not to put any further tariffs on each other while they're in trade talks. But the tariffs that are on are staying in place. So I think there's maybe a little bit more risk of, again, any derailment in the U.S.-China trade talks or any speed bumps than are possibly getting priced in. But I think more importantly than what we got out of the G20 was the market is just listening to the Fed or listening to the way that the market is pricing in what is expected to be the Fed action. I mean, as we go towards the Fed meeting at the end of July, the market just continues to price in rate cuts. We're pricing in about a 30% chance of a 50 basis point rate cut, 100% chance of a rate cut. So as much as we've seen speeches from Fed Chair Powell and a few of the other members talking about the data dependence of the Fed going into these sort of meetings and what they'll do, we definitely have the sense that we will get a rate cut, and that will be an insurance rate cut. But the market's already pricing in 3 other rate cuts or another 75 basis points of rate cuts within the next 12 months. So, a full 100 basis points of rate cuts out of the Fed in the next 12 months. I'm thinking, and a lot of that is more front-loaded, I'm thinking, has the market pushed the interest rate market too far? And it's not just in the U.S., and I think that's also why we're seeing, equities get this bid. I mean, it's central banks everywhere are sort of signaling that they're ready to be easier if need be and aren't tightening like we saw, the Fed embarking on over a year ago now. So with that, you've got yields. I mean, German yields at the 10-year space are about negative 40 basis points. The U.S. 10-year back at 1.95. It was at 3.25, so that's a significant drop back. Yields in Japan flat as well at 0. So you really have to, as an investor, are getting forced out the risk curve to get any sort of return. And I think that's that TINA move that we're seeing, that there is no alternative. You've got to go into the equity market. And I think it'll be interesting, given this price move and the fact that, equity indexes are getting pushed to new all-time highs. I mean, we're 23% on the NASDAQ this year, over 19% on the S&P. Canada's lagging behind, but still up 15% this year. So you can also get a scenario where these new higher highs feed on themselves, and as much as there's nowhere else to get a return on money, then people also have that fear of missing out on markets going higher, and again, just put in a more aggressive bid into prices. So as much as I think we may be seeing markets getting stretched or overdone, given valuations, these sort of moves can perpetuate themselves even further than you think is reasonable.
Well, one of my sources says Trump Fed nominee Judy Shelton says yes to zero interest rates. Does that give you a good indication of where things might go?
Yeah, I mean, I think, the Trump pressure on the Fed has been relentless as far as, what he thinks they should be doing, and so far they've been holding up well. But as I said earlier, it's not just the Fed. I mean, the fact that Germany's 10-year rate is about negative 40 basis points, an all-time low. It's central banks around the world willing to go and stay in very low or negative interest rates. And I think if you look at it on a global scale, you can't have U.S. rates stay so much higher than they are everywhere else in the world. I think it's just inevitable that you will get dragged down. So on a percentage move basis, the moves may be similar, but again, in a pure basis point move, I mean, the fact that, the U.S. 10-year from the high has come off 130 basis points, is massive. It's a very big move. And, if we get the 10-year, what was their last low in 2016? I think we were about 1.35 or so. I mean, can you imagine having the 10-year under 1%? And that's going to be, the Fed likely moving all the way back to zero on the overnight rate. So, is that possible? Absolutely. I mean, we're not that far away from it. We didn't get that many rate hikes. We had 9 25 basis point rate hikes through this hiking cycle. So it wouldn't take much to get us back to zero, especially if they really came into a bit of worry and had to move 50 basis points at a time.
We'll have more with Drew Zimmerman right after the break.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Drew Zimmerman. Drew, U.S. trade numbers don't look all that favorable, and President Trump tweeted today that Europe and China are launching or have launched an unfair currency war. What's your reaction to that?
Yeah, I mean, Trump has always looked at the currency as, being too strong. He's said that on and off on occasion for the last number of years since he's been in office. I mean, the U.S. dollar on a year-to-date basis, not terribly strong for the last 18 months. Even hasn't been that strong. We did have a much stronger U.S. dollar through 2018, and that was when the central bank, when the Fed was tightening their monetary policy while the rest of the world was staying looser. So on a relative basis, the U.S. dollar over the last couple of years has been strong, but maybe not aggressively. The basis for saying that they are manipulating their currency, again, I mean, you can tie it to central banks having lower rates, and again, maybe why Trump pushes on the Fed to have lower rates to, be more even. I think with him it is more a tactic of, his negotiation. Again, the Trump administration looking at a possibility of tariffs on $4 billion worth of exports out of the European Union to the U.S. So if you can say, well, we have to do that because their currency is weaker than it should be, that gives him maybe more of a leg to stand on. Whether or not there's truth in any economic fundamentals to that, I don't think has stopped him before or will stop him again. So it will be interesting to see how it's impacted the U.S. dollar. It didn't move today on those tweets, so I mean they may have more meaning over time if he does more to act upon that thought. But again, just sort of the broad threat of saying, their currencies are too weak, hasn't had any material impact as of right now.
At 76.5 cents U.S., the Canadian dollar's at an 8-month high. Do you see further strength ahead for the Canuck buck?
Yeah, the Canadian dollar has been quite strong, really since the beginning of June. When I look at the Canadian dollar, I really do look at a few key metrics that I think are key drivers of it. One is going to be the interest rate differential between Canada and the U.S. That's narrowed considerably in the Canadian dollar's favor and really helped the Canadian dollar. And that's on the back of the fact that economic data in Canada has really stayed or even gotten stronger, while some of the economic data in the U.S. has softened or not really gone anywhere. I mean, our employment picture has been incredibly strong over the last 18 months or so. Whether or not you believe the month-to-month number, still the trend has been quite strong. Today we just got trade data as well. We had a trade surplus. It's been almost 2 years, I think, since our last trade surplus, so export volumes were up as well, which is always a good thing for Canada. Also, from the start of June, we had crude oil hit a low of about $50, trading back to 57 now, had been up at closer to $60. That always helps Canada as well. We're a big exporter of crude oil. If we can get better prices for that, that's going to help our export side of things as well. So the Canadian dollar is trending better because of our outperformance on the economic data side, which again leads into the outperformance on the bond yield side of things. Can we continue that trend? It could be harder for us to continue. And then, of course, the other big thing when it comes to the Canadian dollar is not, what is the Canadian dollar doing, but what is the U.S. dollar doing? So the fact that it's still holding in near the highs of the last couple of years, even with the market pricing in an aggressively, what I would call an aggressively dovish Fed, the currency really hasn't weakened all that much. The dollar index right now is just under 96.5 after being at a high of 98. So given the circumstances that have helped the Canadian dollar rally, the fact that we've only rallied 2.5 cents in the last month and a half shows me that the market might not be all that receptive to the Canadian dollar getting a lot stronger. A key release, we've got both Canadian and U.S. Unemployment data this Friday. That's going to be a key driver for the currency. If Canada can continue to outperform on an economic front, then I think you're going to see the interest rate differential still move in Canada's favor a little bit further. But we may be running into a wall with how far that can go. So maybe a little bit more upside risk in Canada. But then I think I'm looking more to the worries that could come around that could possibly drive Canada back lower again.
We'll have more with Drew Zimmerman right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, gold prices have become very volatile over the past month and a half. Wouldn't that imply that investors are preparing for risk?
Yeah, you could say that to some degree, and then you would look at the equity market and debunk that. It seems, but I mean, starting in May, I mean, when gold was still down at 1275, we had a very sharp rally, hitting a high of 1440 here in June, just over. So $165 rally in a little over a month is a very sharp move for gold. And I think part of that could be, wanting some diversification, so that risk aspect of owning some gold over time. I think part of it is also the fact that gold had been in a bear market for almost a decade, not quite that long, but about 8 years, and it had been largely forgotten to some degree, and had been sort of left out of the news, left out of what people were talking about trading. So we saw a huge pickup in net speculative positioning in gold over the last several weeks as the prices have really run up. So more investor interest coming back into gold. And for me, the other thing that I look at is the real rate market, what real rates are going to do to gold. And, if real rates are higher, you can earn interest on bonds rather than getting no interest on gold. So as we've seen rates come back off, real rates dropping allows investors to own gold because it's less of a negative when you're not getting much of an interest rate on a bond. You might as well own some gold or diversify into gold. So the real rate's helping. Obviously, the U.S. dollar coming off 98 down to under 96 for a little while helped gold as well. That all got things going, and like I say, I think then that sort of investors coming back into gold sort of helped push that a little further. I'm looking at gold now going, okay, that was a very aggressive move. People had been out of that market. They've come back into it. Have enough people come back in? Have we reached a near-term high, especially when equity markets are reaching record highs? Have we hit a bit of a ceiling here? So my daily gold chart's showing me, two pretty long shadows that would be a sort of a double top at around this 1430 highs around 1440 level. So some closing above the 1430 level could tell me that gold might still have some more room to go. But I'm pricing in the fact right now that I think gold likely got a little overdone. I think the market's been a little too aggressive in pricing in the amount of rate cuts we're going to get out of the Fed, especially near term, and that could have a bit of an effect on gold. So, and that would also help the U.S. dollar if the Fed had to, or if the market had to sort of reprice what they thought the Fed was going to do, that they wouldn't be cutting rates so aggressively. So I'm thinking gold's still a little overdone near term, but I think over the medium term, you are looking at people maybe wondering if the central banks, staying with rates so low or negative for as long as they have, and now seemingly we're going to go, further into negative territory, and stay lower for longer. Are we losing some faith in what the central bankers can do? Equity markets are still cheering, that move, but maybe the gold market off to the side is showing us that there is some skepticism there, and some want to have a hard asset that's not a fiat currency controlled by these central banks. So I think that's going to be a key story to keep an eye on as we go forward. This might be our sort of early move. Again, I think maybe a little overdone near term, but on the pullbacks, I think could be good buying opportunities.
Any thoughts on the action in Bitcoin right now?
Yeah, Bitcoin, I think you could argue maybe the same effect, and maybe just even more pronounced, obviously, than the move that we saw in gold. I understand, or like to think I understand the fundamentals of gold, more so than what the clear true driver of Bitcoin is. Maybe the tradability, liquidity of Bitcoin is a little less, so you see some of the moves when they do happen, happen that much faster and go that much further, especially on a percentage basis. But at the same time, it has had the move. It's held above $10,000 here. It looks like relatively well. A good setback from hitting $14,000. I think it could be, again, over that sort of medium to longer term time frame, owning another asset class outside of cash, outside of typical equity investments, outside of U.S. Treasuries. So whether or not that's a view on somebody's view of what they think the central bank has been doing and what they will do, or if they're just trading a different asset class for a profit, which I think may be more the case in Bitcoin. But you can't really say, and the moves have mimicked each other to some degree, obviously not directly on a daily basis, but they are sort of those two asset classes now that are held out there to say, if you don't want to be involved in a fiat currency, how about these two different asset classes?
Drew, thank you so much for chatting with us.
Thanks for having me on again, Jim.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His website's pifinancial.com and polarfuturesgroup.com. If you have any questions for Drew or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.